The Silver Institute is forecasting that investors will buy 200, I think it's 200 million ounces of silver in investment gold this year. When you divide that number out by the population of the planet, you'll find that's one person in 45 or something like that can have 1 ounce. Now, I know half the world probably can't afford anything in silver, but even so, if you think about it, if you have 1 ounce of silver alone, you're already ahead of the other 46 who won't be able to have it, because there just isn't enough. If that 200 million ounces figure, that estimate going into investment demand, is correct. Now, if that figure it turns out to be 400 million ounces, because actually there's more than one person of 47 wants to buy an ounce, or that one in 47 persons wants to buy 2 ounces, well, where's it going to come from? The mined output is relatively inelastic, so the only place that extra silver can come from is recycled silver. And the only way you get recycled silver is to have a higher price than yesterday.
There are moments in every commodities cycle when the math simply stops adding up. And today, silver is sitting right on that fault line. Clive Thompson starts with a figure that most analysts ignore: an estimated 200 million ounces of silver projected to be absorbed by global investment demand this year. When you divide that by the world population, you get a staggering conclusion. Only one person out of roughly 45 can even get their hands on a single ounce. And that's assuming demand doesn't rise. In reality, demand is rising, and half the world can't afford to buy anything at all. That imbalance alone tells you why silver is no longer just a metal, it's becoming a scarcity event. And if that 200 million ounce forecast turns into 400 million ounces, which is entirely possible once investors in Asia, the Middle East, and the West begin accelerating their allocations, the supply gap explodes into a full-blown crisis. Mine supply simply cannot scale in time, especially with grades falling, permitting delays growing, and capital investment lagging for more than a decade. That leaves only one source: recycled silver. And the only way recycling ramps up is exactly how Clive frames it. The price must be higher tomorrow than it is today. Silver may still look cheap, but structurally, it is already behaving like an asset undergoing a supply squeeze. Meanwhile, gold is telegraphing a deeper shift at the sovereign level. Central banks are now the most aggressive buyers in the world, with large institutions accumulating gold quietly and deliberately. Some, especially China, are buying without reporting it. Despite producing 20% of the world's gold, China's official reserves have mysteriously plateaued since 2014, even as its trade surplus keeps rising. That divergence signals covert accumulation, and when you combine it with the steady flow of 400-ounce bars from Switzerland and the UK directly into Chinese vaults, the picture becomes unmistakable. The world's largest players are preparing for a monetary realignment, and they are doing it with physical gold, not dollars. Retail investors in the West remain almost completely uninvolved. ETF outflows, despite gold making new all-time highs, tell an incredible story. Retail is selling while sovereign and institutional buyers are accumulating at record levels. Every previous major gold bull market ended only after the masses piled in, and we are nowhere near that point today. This is the early phase, when the quiet money positions itself long before mainstream attention arrives. And that brings us to the next section of Clive's analysis: the role of central banks, the mystery buyers supporting gold at record highs, and the structural lag inside the global banking system that explains why the real move hasn't even started yet. Before we continue, make sure you subscribe, give this video a like, and turn on notifications. These deep dive analyses are for viewers who want hard data, not mainstream soundbites. So if you appreciate content like this, your support helps keep it going.
We've seen a lot more central bank buying in the last few years, and many of the indicators are that some central banks are buying gold and not telling anybody about it. They're doing it covertly. The biggest candidate for that is China, where they produce about 20% of the world's gold from their own mines. There's also, and I don't have concrete evidence of this, but there's a lot of people who seem to have done the research and got the evidence. There's also large quantities of 400-ounce bars being exported from Switzerland and the UK to China. And these are not the sort of bars which are used at the Shanghai Stock Exchange, which uses 1 ounce, 3 ounce, 100-ounce bars, and they're not the sort of bars which are used in the jewelry industry. So these are the sort of bars which are used by central banks for storage. So there's the internal production of coming from China's own gold mines, perhaps 20% of it going into their reserves, secret reserves. We've potentially got a lot of bars moving to China, which we don't know where they're going, but they're the type of bars which would be held by central banks. And then the last thing we've got is since 2014, China's official reserves, which is basically treasury bonds and gold and special drawing rights, the official reserves have plateaued. Now, that's odd when China's trade surpluses have ever since continued to climb every year. Their trade surplus has been climbing, their current account surplus has been climbing. So for decades before that, as this trade surplus was climbing, the reserves would go up. It wasn't a one-for-one match, but more surplus trade means more money in the central bank. Suddenly it seems to have plateaued since 2014, which kind of implies they're still potentially building up the reserves, but they're not reporting it. So why are they not reporting it? Because perhaps it would hack off the Americans to know they're buying gold. So they are buying a little bit gold. That's officially reported numbers. But the numbers that they're buying, whilst they're pushing up gold as a percentage of their reserves on the balance sheet, it's still looking like it's relatively small. But reality, it's probably quite big. And I expect the central banks around the world, which are also building up reserves. I saw an article saying that there's less central banks now reporting their gold purchases than ever before. So implication is there's probably a lot of buying, and that's probably why the gold price has reached an all-time high of 4,000. Well, the high was a bit higher than that, 4,400, but let's call it 4,000 for simplicity. And simply speaking, most central banks are insensitive to the price. They don't care. They're not buying with a plan to sell tomorrow to make a profit. They're buying because they want a plan B, which does not involve the dollar.
Would you agree with the statement that, in general, masses in the West are still not that involved with this market?
I believe that up until a few weeks ago, maybe only for a week or two, when gold was peaking, there were net purchases in the ETFs. But long and short of it is the number of tons of gold held by the exchange-traded funds in the West have been kind of falling. So as the price went up, retail investors have been coming out of gold and going into tech stocks. But the gold price keeps going up. So it's not the retail investors who are involved in the market, it's someone else. And now these could be big hedge funds, it could be central banks, it could be the US government itself, we don't know. But there's someone out there who is buying gold at the same time as retail investors are selling it. Why? Who is this buyer? Who are these buyers? We don't know. In terms of the public at large getting involved, we're still a long, long, long way away from it. If you look at it, just a tiny fraction of NVIDIA's market cap or Microsoft's market cap or Apple's market cap and so on, if that was to find its way into the gold mining sector, NVIDIA's market cap could buy the entire gold mining sector 4 times over if the price was where it is today. So if you can imagine just even a tiny percentage of NVIDIA going to the gold mining sector, those shares would go through the roof. And now we've seen a very large rise in gold mining stocks this year, indicating that there is some interest in gold. But I can tell you factually that many banks who say they've been promoting gold don't actually have any gold in their client portfolios yet, or just starting to put it in. I think it will go in 2026. It's a very long and difficult process when you decide to go from zero in an asset allocation to anything above zero for any asset you like. I know that because I've worked in banks all my life, but just so, people think, oh, it's easy. The bank decides we're going to put 5% in gold and it's done. It doesn't work like that. Let's say the chief investment officer decide that 5% in gold would be a good idea as opposed to 0 or 1% or whatever the number is. There's multiple departments now need to be involved. You need to have the legal and compliance departments involved to make sure that is legal under the rules of the country in which you're operating. You need to look at the types of clients to find out if there are certain types of clients where that would be not allowed. For example, in Europe, if you take Luxembourg insurance policies, which are, there's many of them investing through Switzerland, the Luxembourg insurance rules do not permit the holding of physical gold. So, these are things which legal and compliance have to look at. You made a decision to do it, but they've got to look at it and say, okay, let's take it. It may be illegal or not allowed for clients in certain countries. Then you've got to look at how are you going to get your exposure to gold? Do we buy the physical metal? Do we hold gold in account? Do we have an ETF? Do we do it through the miners? Do we make a customized instrument, a structured product to do it? Do we go for a hedge fund? There's lots of different ways of getting that exposure. So that has to be examined by a department who looks at all the possible ways of getting exposure to see how it can be done.
Clive's breakdown of central bank gold demand exposes a monumental shift that the Western public has not yet recognized. The World Gold Council's own surveys show that roughly 75% of central banks plan to increase their gold holdings over the next few years. Yet the reporting of these purchases is fragmented, late, or deliberately concealed. When you add the disappearance of Western 400-ounce bars, the stagnant official reserve numbers in China, and the rise in gold prices despite ETF outflows, the conclusion is unavoidable. The buyers driving this bull market are not retail traders. They are governments, institutions, and large undisclosed entities positioning for a post-dollar world. Clive also makes a critical point regarding Western banks. They are barely involved. Even banks that publicly promote gold often have zero exposure inside client portfolios. Shifting from 0% to even 2% or 5% is a bureaucratic marathon involving legal, compliance, product structuring, client restrictions, and internal risk committees. That process takes years, which means the large-scale institutional money hasn't even started moving yet. When it does, the gold mining sector, which Nvidia could theoretically buy 4 times over, could experience flows powerful enough to reprice the entire industry.
How are you viewing at silver in the current environment?
Well, that's what's been happening. Silver has outperformed gold in the current bull market. And I say bull market because I think we're still very much at the early stages of that. So obviously on the industrial side, it's a possibility that the demand will slide a little bit at the higher prices, but that's counteracted by the investor demand, which now wants to buy silver. Now, the Silver Institute is forecasting that investors will buy 200 million ounces of silver in investment gold this year. When you divide that number out by the population of the planet, you'll find that's one person in 45 or something like that can have 1 ounce. Now, I know half the world probably can't afford anything in silver, but even so, if you think about it, if you have 1 ounce of silver alone, you're already ahead of the other 46 who won't be able to have it because there just isn't enough. If that 200 million ounces figure, that estimate going into investment demand is correct. Now, if that figure it turns out to be 400 million ounces, because actually there's more than one person of 47 wants to buy an ounce, or that 1 in 47 persons wants to buy 2 ounces, well, where's it going to come from? The mined output is relatively inelastic, so the only place that extra silver can come from is recycled silver. And the only way you get recycled silver is to have a higher price than yesterday.
Yes, great point, Clive. Would there be any other commodities that you would be interested in, maybe like copper, uranium, or anything else?
I haven't done a detailed study on copper yet, but everything I'm hearing from people who have done so says that the copper demand from everything from electrification of cars to data centers and all kinds of other things, the electrification of the world, in fact, is set to be higher in the future than it is at the moment. And it does take a long time to bring on stream new copper supplies. So if what I'm hearing is right, I think I'd be relatively bullish on the long term for the copper, but it's not really in much of a bull market yet. And I think that might just be indicative of the slowing economy, because copper will be much more prone to the ups and downs of the economy. So where I'm sitting on copper is I'm thinking I should start to buy copper miners. I haven't started yet. And I think the way to do it is slowly and gradually over the next 6, 9, 12 months. I don't think there's an urge to rush in because obviously we do go into a recession. If we go into a recession, it won't be good for commodity companies in general, I think. So, I'm not going to go all in, even if I do start buying. But I think buying gradually will give me a range of prices. Maybe some will be higher than now, some lower. I don't mind, but at least I won't be buying everything at the top of the market.
And what about uranium, Clive?
A couple of years ago, I did a study on the uranium demand is going to go up. A couple of years ago, I did a study of the uranium companies I could find at that time, and I basically turned away in disgust because they were all massively overpriced, in my opinion. So I didn't feel uranium itself. If you know how to store it, probably you're onto a good thing. But getting the shares of the mining companies didn't seem like a good idea a couple of years ago. Maybe I've been proved wrong. I haven't checked the prices, but I haven't gone back to look at them either. But I suspect they haven't got cheaper. Let me just say one thing. The money that you hold in fiat base, whether it be bonds or money market or cash or deposits in the bank or physical cash, there's never going to be any less of it with any Western government. In other words, all the governments of the world, broadly speaking, effectively getting poorer on a day-by-day basis because they're overspending. When you can print money, it's very hard to stop it. We're not on a gold standard where there's a natural restraint. And therefore, the amount of liabilities of your government, which includes the central bank and the government itself, are just going to get bigger and bigger and bigger, which means your share of the wealth, if you happen to stay in cash, is going to get smaller and smaller, even after you've earned some interest. And that's before you paid tax. So even though you might be earning 4% on your money, the government is printing away officially on an annualized basis about 6.5% of the United States. But if you look at it on the last, since July, they've been printing at a 13.5% annualized rate. Obviously, that's a bit of a short period. It doesn't take into account the fact there was a debt ceiling and doesn't take into account the flow of tax receipts, which don't all come at the same time of year. But over the long run, over the last few years, they increased the debt by something 6.5%, and that figure is set to rise. So if you're only earning 4%, you're going backwards by 3%. So if you've got another 30 years to save, so you've got your savings, let's say you've got 100,000 in the bank, and you've got another 30 years before you expect to die, and the government is getting poorer to the tune of 7%. Let's say that doesn't even increase, and they're only paying you 4 minus your tax, so you're actually getting 2. Let's say so 7% at one end, 2% at the other end. You're getting poorer to the tune of 5% a year. How much have you lost over 30%, over 30 years? Don't answer that one, but I can tell you it's a lot.
Clive then circles back to silver, emphasizing that the metal is already outperforming gold in this bull market, and we're still early. Industrial demand may cool slightly at higher prices, but investment demand is now the dominant driver. And once investment demand dominates, prices tend to accelerate violently. When an asset that is structurally scarce meets a wave of new buyers, the revaluation is swift, unforgiving, and usually permanent. The math doesn't lie. 1 ounce already puts you ahead of 46 other people on the planet. On copper, Clive remains cautiously bullish. Long-term demand is real, driven by electrification, EVs, data centers, and grid expansion, but copper is economically sensitive. That's why he prefers the gradual accumulation of copper miners over the next 6 to 12 months. It's a measured, strategic approach in a market that will likely reward patience more than aggression. Uranium, meanwhile, remains fundamentally strong on the demand side, but mining equities are still expensive, and Clive hasn't seen a compelling entry point since his last deep dive review. What ties all of this together is the decline of fiat credibility. Clive notes plainly that Western governments are getting poorer by the day, drowning in debt and unable to restrain their own money creation. When a system can only function by issuing more liabilities, the long-term outcome is predetermined. That is why institutions and nations are exiting the dollar, not with announcements, but with quiet, relentless purchases of physical metals. Gold for monetary insurance, silver for scarcity and asymmetric upside, copper for structural industrial demand, uranium for energy security. And this is why today's market environment favors the informed contrarian. The public is still distracted by tech stocks. Western ETFs are leaking gold. Banks have barely begun their allocation processes. Yet central banks, sovereigns, and deep-pocketed buyers are absorbing physical ounces at the fastest pace in modern history. The window where metals remain under-owned, misunderstood, and undervalued will not stay open forever. The data is already screaming that the next phase of this bull market will be driven by scarcity, by institutional repositioning, and by a monetary system that is losing credibility faster than policymakers can contain. If you found this breakdown useful, subscribe and share this video. It helps push this research to more viewers who are trying to make sense of the biggest monetary shift in decades. And let me know in the comments what you want the next deep dive to focus on: silver supply, central bank flows, mining equities, or the next phase of de-dollarization. Thanks for watching.